Welcome back to your Three Towers Investing channel. In this video, we will be talking about how a beginner should start investing. For new investors, there are various investment options available. But where do you begin? But before we proceed, please don't forget to hit the like button, share, subscribe, and click on the notification bell so you won't miss out. The common myth about investing is that it is just for the rich and that you need a huge amount of money to begin. This may have been true a few decades ago, but it is no longer true in 2022. So where do you begin? Number 1. Stick with the golden rule. You should never lose money. This principle was devised by Warren Buffett, an investment guru who has made a fortune by following it. The easiest way to achieve this is to invest when an option is undervalued at appealing prices. You will be paying less than the genuine price as a result of this, which could later make you a lot of money if normalcy returns. To reduce risks, avoid short-term investing. Instead, search for long-term investment solutions with stable returns, rather than short-term trading. Warren Buffett has built his fortune through long-term investing. Short-term trading has a number of costs that are charged in fees, as well as a number of uncertainties that can result in significant losses. Many other billionaires have made their fortunes through long-term trading, which has proven to be increasingly important over time. Number 2. Identify your investment destination. Create a portfolio strategy and define your goals when you first start out. Ask yourself, how much money do you want to make in the long term? And how much do you want your net worth to be? Devise a strategy for getting there. After that, determine which investment possibilities are profitable and whose return rate will provide you with the revenue you desire within the time constraints. When making investment selections, keep this in mind. Number 3. Buy stocks wisely. Buying shares in a single firm as a beginner can be one of the greatest ways to invest your money. You may make as much as 15% a year by investing in the right company. The most significant consideration is choosing the best company and timing. This will require conducting a study on the selected company's prior performance and management. Don't invest straight away if you found a company that fulfills your criteria. Keep the company on your radar for a while. Keep an eye out for price drops while you wait. Buy when the stock price drops. Once the company returns to its true value, you will have a great bargain and profit. It's critical to keep your emotions in check when investing. Recognize that markets are extremely volatile, and even the most successful organizations can have downturns. Don't be alarmed or make hasty judgments as a result of any significant changes. Wait, be patient, and think about the circumstances before making a choice. Never allow fear to influence your buying or selling decision. You will almost always be wrong and doing exactly what the market wants you to do. The beauty of today's investing is that you don't need a lot of money to get started. You can start with $1,000 and quickly expand your account to tens of thousands of dollars. When investing, stay away from penny stocks. Penny stocks are companies with a market capitalization of less than $5. These stocks may be appealing due to their inexpensive pricing. They are, however, extremely volatile, and there is little to no information about them available online. The majority of penny stocks are for tiny businesses that are fresh to the public market. Number 4. Consider innovation and technology. Don't be a noob. Why not try an investing app? Technology has arrived to save the day, and more accurately, to save inexperienced investors. There are various beginning investing apps available nowadays. Some even round up your credit or card purchases and invest the difference in an ETF portfolio. These apps will handle your portfolio in the same way as robo-advisors do. If you insist on doing it yourself, There are numerous programs available that will train you and teach you how to invest. Most have low fees and are convenient because they can be accessed from any device at any time. Another form of innovation and technology is robo-advisor. These are robots that provide financial services such as building portfolios and picking investment options on behalf of people. As the name implies, robo-advisors are an excellent alternative if you don't know much about investing. Robo-advisors will use computer algorithms to manage all of your investments because their systems have low overhead. Their operating expenses are lower than hiring brokers to administer your account. Using a robo-advisor will cost you between 0.25 and 0.50%. Whereas hiring a personal financial advisor will cost you between 0.5 and even 5%. This is an easy way out if you are a rookie and don't have a lot of money. However, we are not suggesting that you delegate all of your responsibilities to them. You must still keep track of where your money is going and what is happening. If you're interested in learning more, several advisors have instructional information and resources that can help you understand the processes better. It's a less expensive, more convenient, and a tried method of investing. Number 5. ETFs and Index Fund. Index funds and ETFs, or exchange-traded funds, are very similar. They both follow the same market index and invest in the same way. When compared to mutual funds, these funds also offer lower fees. The key difference between the two is that instead of requiring a minimum investment, ETFs are traded continuously throughout the day and have a fluctuating share price. The share price represents the ETF's minimum investment amount, which can be as low as $1 or as high as $300. Because they are exchanged on a daily basis, they involve brokerage expenses in the form of commissions. Many people have made a lot of money with them, but they necessitate a great deal of research and alertness. You will need to devote a large amount of time, if not a full-time investor, to truly prosper with them. Index funds are best described as mutual funds on autopilot. It's a fantastic alternative to paying a portfolio manager to do it for you. An index fund, on the other hand, will follow a certain index. A market index is a group of investments that reflect a portion of the overall market. The S&P 500, for example, has the stocks of 500 of America's largest corporations. The S&P 500 fund will invest in the stocks of companies in the category, mirroring their performance. The expenses are cheaper because the funds use a passive investment strategy that entails tracking the broader market index rather than hiring a professional portfolio manager. Investing in index funds, like mutual funds, entails purchasing a portion of the entire market in one transaction. The majority of index funds have minimum investment requirements, while a few brokerage funds do not. Isn't that incredible? In the long run, this investing strategy is preferable. Number 6. Mutual funds. This investing option will invest money automatically based on your expected retirement year. Mutual funds are similar to retirement plans. A mutual fund is a collection of several investments in which one investor purchases a share of the fund and thereby invests in the fund's whole portfolio. These funds are managed by experienced fund managers who decide how the money is invested, but each one has a certain theme. An equity mutual fund, for example, will invest in equities. The targeted mutual funds will almost always carry a combination of bonds and stocks. If someone expects to retire in 20 years from 2022, they can choose a mutual fund that is labeled 2042. When the term expires, the investor will be deprived of the investment's profits. Number 7. 401k or employment retirement plans. As a new investor, the greatest place to start is with a retirement plan. Some employers will match your contribution. For example, if you donate 2% of your salary, your employer will contribute another 2%, equaling the amount you placed in the plan. It may appear to be a little sum, but it is free money that will compound over time. If you are under age of 50, you can contribute up to $19,000 to your 401k. And if you're over 50, you can contribute up to $26,000. The benefit of this investment plan is that there is no necessary minimum deposit. You may begin with whatever amount you can afford. When you choose a plan, the payment will be debited from your account automatically because most retirement plan deductions are done before taxes. You'll save a lot of money over time. Compounding also plays an important role in developing your money. Compounding allows a little monthly commitment to grow into a substantial sum in a few years. I hope you learned something from our video today, and I'll be very happy if one day you achieve your financial goal. And that's it for today's video. And if you haven't done it yet, please don't forget to like, share, and subscribe for more videos about finance, investment, and innovation. This is your 3 Towers Investing channel. Thank you for watching, and I'll see you in the next video.